Welcome to Geojit Spotlight. Geojit Chief Investment Strategist Dr VK Vijayakumar joins us to share the current market trend. Dr. VK, after the March 2020 crash, markets staged a smart recovery. Nifty doubled in around 16 months. The returns in 2021 was very impressive. This year in 2022, markets are struggling. What kind of returns can investors expect going forward?
Well, the returns have been very good after the market crash of March 2020. In fact, Nifty doubled in 15 to 16 months. But this year, in 2022, markets are struggling. Globally, markets are struggling. The reason is that there are too many headwinds for the global economy as well as for the markets. Number one, inflation has become a global phenomenon, and central banks everywhere are raising interest rates and tightening monetary policy. In US, in India, in other emerging markets. In Europe, the ECB has said they will be tightening from July onwards. So an aggressive monetary tightening environment is not very favorable for the stock markets. That's why the markets are struggling. Secondly, the war in Ukraine has led to increase in the prices of oil, energy, metals. So that is another major headwind for the markets. And the lockdown in China also has created disruptions in supply chains, adding to the problems. That's why the markets are struggling in 2022. It would be realistic to expect only modest returns in 2022. But then investors should not be focused on returns for the next 6 months, returns in 22 or returns in 23. Investors should have at least a 4-year time horizon. You should be investing for the long run, for the next 4 years, next 10 years, 15 years, ideally. So, because of markets are cyclical, markets move in cycles. During certain periods, returns will be modest. Like during 2015-19, returns were very, very modest. But after the global crash of 2008, the market staged a smart recovery in 2009 and 10. Similarly, during 2003-2007 end, there was a massive bull market. Actually, Sensex multiplied 7 times during this period. So investors should be focused on the long run, where you will be getting extraordinarily superlative returns, rather than focusing on return for the next 6 months or 1 year.
During the last 2 years, more than 4 crore retail investors have entered the market. What is your advice to these new investors?
During the last 2 years, there has been an explosive growth of retail investor population. More than 4 crores. This is actually equal to the total number of retail investors who entered the market in the 20 years before that. That is a desirable trend, because when retail investors enter the market, they will also be participating in the wealth creation through the stock market. Therefore, it is desirable. But then there are areas of concern regarding retail investor behavior. Since you asked me my advice to retail investors, I will summarize my advice in 4 points. 2 don'ts and 2 do's for retail investors. The 2 don'ts are, number 1, don't invest in low-grade stocks. Don't invest in penny stocks. Most retail investors, when they enter the market for the first time, invest in low-grade stocks. Don't do that. Second, don't speculate and trade in the market and lose money, because vast majority of traders lose money. These are the 2 don'ts. And the 2 do's are, number 1, invest in high quality stocks. This is very important, because if you invest in high quality stocks, returns, long-term returns are assured. So invest in high quality stocks. Second do is invest through the mutual fund route if you don't have expertise to invest in the market directly. Ideally, invest through systematic investment plans in mutual funds. These are the two don'ts and two do's for retail investors.
You advise the investors to invest in quality stocks. Could you please elaborate this?
Well, quality stocks are high quality stocks are blue chips. Blue chips do not have a very clear, accurate definition. These are stocks which have delivered consistent returns over a long period of time. Stocks of companies with a very good track record, very good promoters, clean accounting, consistent performance over a long period of time. There is a very simple technique to identify blue chips, a simple technique. That is, investors can go for market leaders in every sector, in every segment. To elaborate this point further, there will be market leaders in all segments. Take banking, for instance. The clear market leaders are HDFC Bank, ICICI Bank, Kotak Bank, State Bank of India. In NBFCs, the market leaders are HDFC, Bajaj Finance, Bajaj Finserv. In IT, the market leaders are TCS, Infosys, Wipro, HCL Tech. In the FMCG, you have great companies like HUL, ITC, Nestle. In construction related segment, you have stocks like Asian Paints, Pidilite. In engineering, you have Larsen & Toubro capital goods, that is L&T, ABB, Siemens. Similarly, in automobiles, in cement, you have market leaders with a sizable market share and also good pricing power to produce consistent results for the long run. So this is one easy way of identifying high quality stocks. These high quality stocks never disappoint. They deliver consistent returns and create phenomenal wealth for investors in the long run.
Thank you, Dr. VK. Thank you very much.
Thank you.